going live. We're live now, I think.
I guess we are.
Let's see. Okay, yeah. There are already some users online. We will wait up to 4 o'clock before we start. Let me see if I press the play button. There are already some users online. We will wait up to 4 o'clock before we start. Let me see if I press the play button. There are already some users online. We will wait up to 4 o'clock before we start. Let me see. Okay. Don, everything is fine now? Sound check again?
Absolutely.
Okay, perfect. Do you want to test the share screen option?
Yeah, let's do that. Let's go to the PowerPoint presentation, start screen share, and I'll quickly go all the way to the beginning.
Yep.
I will put it on full screen. How's this? Can everybody see? Can you see, Maurice?
I can see it, but let me see. I've also... Okay, one moment, because I'm testing it also in another... Yeah, perfect.
Sounds good.
Okay, now let's wait for another minute before we start. Just double check with the people who are now participating. Can everybody hear us clearly? And could you please reply in the chat? Nobody's replying yet.
I can hear you, Maurice. So.
Yeah, you can hear me. Yeah, but it would be nice if the others also let us know via chat if they can hear us clearly. Okay. Now let's start. I think 4 o'clock being Dutch is 4 o'clock. So briefly an introduction to Don is that Don and I know each other for quite some time. Don is an expert in employee benefit programs, and therefore I invited Don for this AMA session. Don also participated in the first Startup Scale-Up Week in Zoetermeer and told the story to our group. And therefore, we were inspired by saying, okay, let's also have Don do a talk on the AMA session, because therefore there more people can also participate in the session. We will start off with a kind of PowerPoint where Don will take you through some of the questions that most startups will have. And after that, of course, there's time for questions, and ask them via the chat screen, so I can then ask them to Don, and we can tackle all questions via that route. I will mute my mic so the screens don't swap all the time, and then I can say, Don, the floor is yours.
Thank you very much, Maurice. Well, welcome to all of you who've joined. Pleasure to be here with you today. Yeah, like Maurice said, my name is Don-Tobias Jol. I work with Deloitte in Amsterdam within the tax and legal practice. And I lead the group called Executive and Equity Compensation. So basically what we are focusing on is the remuneration packages of senior management in a company. And these companies could be any type of company, both listed companies, international ones, family-owned businesses, but also startups and scale-ups like most of you will be. So basically, yeah, from that angle, we focus also on equity-based pay, so remunerating your employees by shares and share options and so forth. And within that framework, I've been in contact with Maurice for quite some time now, indeed, in advising startup companies on how to remunerate their employees efficiently with equity. So that's basically a brief introduction of myself. I will now try to share my screen with you all, so you don't have to look at my face anymore. Let's see if that works. Yeah, if I'm correct, then you guys can all see the presentation now. And this presentation is called Paying Your Talent in Shares, because basically that's the key topic that we find interesting for startups at this stage. How do we find a way to remunerate our employees cost efficiently? Because as you can see in most startup companies, especially in the beginning of their life cycle, cash is scarce, and therefore we found some jokes which illustrate this point quite clearly. For instance, somebody working with a startup company wanting to propose to his love interest with a ring valued at the typical 2-month salary, but the ring isn't visible because 2-month salary equals a very, very small ring. Or another one that we found, and that's also the last one, is the HR person working at a startup company saying, we believe in paying our employees as much as they need. Since you'll be at your desk for 90 hours a week, you won't need much. And of course, that's also a point. And a lot of hard work is done in startup companies. And yeah, remuneration doesn't, cash remuneration at least, doesn't always keep track with all of the efforts that are put in. So the alternative is to provide equity to your employees. Equity basically meaning shares, share options, stock appreciation rights, and so forth. So we see this especially in the startup communities. We see that this is quite normal. It's becoming ever more normal to say, I'm giving away my firm to the workforce. So basically, where I used to be the sole shareholder of a company, I am now giving an X percentage of my shares to my employees. And while that means that my total shareholding decreases, the value of my remaining shareholding will increase because we can create more value together. That is the basic proposition. You get less shares, but each share becomes more valuable because basically you can attract better talent for your company. So Deloitte has a certain community of startup companies, which is called the Fast 50. And Fast 50 means that every year we look at a lot of startup companies who've been in business for at least, let's say, 2 or 3 years. And we see how much have they grown year on year, and is this growth sustainable? And then when we've identified them all, we rank them from 1 to 50. And obviously number 1 gets a prize, and everybody gets together for a lovely party where the prize is given to the winners. And this is a community that we can use to also interact with people who are really in the startup business. This is a Dutch community, and we have a couple of months ago we've done a poll among this community, and we've said, can you answer some questions around paying your employees in shares? Because we would want to know a lot about how they felt about it. So again, as a startup of this whole AMA session, we just wanted to briefly share some of the outcomes of this survey with you to give you an impression of at least what the thinking is here in the Netherlands with startups on equity-based remuneration. So the first question we asked them, and it was already the answer was already quite interesting, was, does your company have an employee equity plan in place? And it turns out that like the vast majority of Fast 50 companies do not. It's around 3/4 of the companies don't have an employee equity plan in place at this stage. So there is, in our opinion, obviously room for growth. This is good news for Deloitte because then we can obviously reach out to all of these companies and advise them on these plans. But it's also interesting that a mechanism like share-based pay is not that common yet in at least the Dutch startup company community. So then the next question was, if you had a share plan and you would be giving shares or providing shares to your employees, how many of the total shares would you be able to would you be willing to grant? So then you see, well, the majority chooses a percentage of between 0 and 5%. Then the next biggest majority is between 5 and 10%, and only around 20% of the respondents said, no, we would be willing to grant more than 10% of my own share capital to my employees. So 10% seems to be like more or less of the limit that the shareholders of the current shareholders of the startup would be willing to give away to their workforce. So that's interesting. And we were able to check these outcomes with some more European-based research, which was done by the European Federation of Employee Share Ownership. Seems like the right people to ask. And they did a survey in 2014, and you can see in this graph quite a few of the outcomes of their survey. So it's quite interesting. First of all, you see that there are a lot of European employee owners. You can see the number there. And the typical amount that their stake is in the company is again between the 0 and 5% that we saw in the previous slide. So it's now at 2013, which was the last year that they measured, around 3%. So basically people are willing to give away around 3% of their share capital to the workforce. Then there's some other interesting data in this table as well. You see that almost all European companies have employee ownership. So basically they have a form of employee ownership, if it's even only like the board or more people, but it's quite normal in Europe. Broad-based plans, however, so basically a broad-based equity plan is an equity plan whereby in principle everybody who works at the company is able to participate. That only happens in around 50% of the cases. So only like half of European companies have a broad-based plan. Stock option plans are quite common. You see them at 63%, and there's some new plans coming, every year in European companies. Now, if you ask yourself, okay, European companies, what countries are involved in this? In this investigation, you see them here at the bottom of the slide. If you are an avid car traveler through Europe, you will probably be able to recognize all of the abbreviations at the bottom. I'm not sure if I could do them all: Romania, Lithuania, Estonia, Luxembourg, but probably you will be able to find your own country there. And this is an interesting graph also because it says, okay, if we have a share plan in a company, which, as we've seen in the previous slide, almost always is the case, how many of the employees are then, owning shares? And that is, so basically, if you look at the typical company in Europe, you see that about 27% of its employees have a form of employee equity ownership. So it's, it's around a quarter, and that's probably going to be the upper quarter of the population.
Don, one question, because if I look at the slide itself, it doesn't show everything at full screen. So I don't know how that is possible, but people only see the mediocre line stating the average percentage.
Okay. Well, there's no way that I can fix that right now, but we will be sharing these slides later on with the community.
Yeah. No, true. But please keep in mind then that not everything will be shown. That's
a very good point. And okay, so this makes it even more important for everybody listening to later on also look at the shares that we'll be sharing.
Yeah.
Okay. So going on to the next slide, I hope this one is visible with all of the colors in it. Is it, Maurice?
Yes, this one is visible.
Okay, excellent. All right. So I think, what we talked about before, there is a number of different types of plans that you can have in your company. And we have a more broad discussion on that later, but for the sake of this particular slide, we name a few: the stock appreciation right, whereby you get basically a bonus which is connected with the share with the value increase of your shares. Your stock option plan, I think one of the more well-known equity plans that you have here in basically not only in the Netherlands but throughout the world. The entitlement to buy a share at a later stage, usually at the value that the share has now. That's a typical option plan. And the share purchase plan, which can be a plan whereby, for instance, you either buy shares at a discount, so your share is valued at 10, you buy it for 5, or you get the buy one get one for free type of a deal, whereby just an additional share is given to you. So these are some of the more typical equity plans that are in place. And you see within the Fast 50 community of Deloitte, all of these plans are more or less, equally popular. There is not one that stands out a lot. We, as Deloitte, we do our own survey on an international basis each year. And we ask a similar question. And I just wanted to put this one out here as well, because this is more European based. We do this actually, we do this survey throughout the world, and we can then match it for instance, the Europeans or the American companies that have participated in the review. So this is what we see as a result for Europe. What type of plans are operated internationally? And then let's first look at the top one, the bonus deferral plan. And we have made a distinction between either executives participating or again the broad-based plans whereby everybody in principle can participate. So a bonus deferral, which basically means you get a bonus, which bonus could be connected to either the profit of the company or the share price increase of the company. This is typical for executives. You don't see that a lot for the broad-based plans. Share purchase plans, we've discussed this before. Basically, you get the opportunity to buy a share at a discount or with an additional matching share. These are again typical for the broad-based plans. So you see that the opportunity to buy shares in your company is provided usually at a broad scale and available to all employees in the company. The options are equally popular with the executives and with the broad-based population. And the share awards, which is basically getting your shares for free. Again, this is one of the perks of being an executive. You get your shares for free. It's more popular for them than giving free shares out to the broad-based population. Okay, the next question we had is, again, who would you grant equity incentives to? So coming back to the previous slide, would you give it only to your executives or to everybody? And we made a distinction. Okay, so the possibility is to grant shares to all of your employees with regular grant cycles every year. This is quite popular within the Fast 50 community. Executives, again, also quite popular. However, what is not done often within our Fast 50 community is to provide shares only to existing employees, let's say the founding staff, so the people, the relatively few people who started off a startup get the shares, and then after that the new joiners do not get any shares. This is an uncommon way of providing equity in startup companies. And then sometimes you also have the specifically designated plans, which are tailored, for instance, for the sales force or for, let's say, IT developers, and they have their own plan, which is specifically tailored to certain KPIs that they have to meet. And then, again, coming to the conclusion of our survey, why would you do it and why would you not do it? Those were the final questions we had. So what are the reasons for you to implement a equity plan within your company? Well, right there at the top, most answers is, well, we want to attract, retain, and incentivize talent. That's basically the main reason. You get your shares, you think, oh wow, I am a really valued employee of this company. I get these shares, and I'm hoping that they will increase in value. This provides me with an incentive to do my best for the company. Also mentioned is the fact that if you provide shares instead of cash, this obviously creates a reduced cash out for your company. Because instead of using your working capital to remunerate your employees, you can now use it to either develop or to enhance your proposition and so forth. And still your employees might be more incentivized because they have this share benefit, that is awaiting them. Another famous reason why, or important reason why people have chosen for an equity plan is that it aligns the interests of the employees with those of the shareholders. Naturally, if you're an employee and you have a share, you start to think like a share owner, and therefore you do what the share owners like you to do, which is basically increasing your equity value. Everybody seems to be geared toward that if everybody is a shareholder. And these, again, we listed some of these reasons and actually added some more that were not in the survey, but in our opinion are also important reasons to have an equity plan in place in a startup company. So the top ones are already in the survey: attracting and motivating your employees, aligning with the shareholder interest, tailoring to specific groups. But there are also tax planning opportunities. In many countries, it is more tax efficient to have an equity plan than, for instance, to be simply paid in cash. In the Netherlands, for instance, you can say, okay, a startup company in its beginning of its life cycle, the valuation of it is quite low. So the share price is quite low. If you then provide these shares for free, the taxation is on a relatively low value. Then, after that taxation has occurred, the shares become part of your personal wealth, which is low taxed in the Netherlands. And if you then see, like in 3 or 4 years' time, the value of your shares in the startup company has increased tremendously, there is only a very low taxation on it. So that can then provide you with the tax benefit, as compared to the situation where you would be getting, a very large cash bonus at the time when the share price is high. Your tax burden on that would be much higher than in the alternative situation. It reduces the cash out. We've already discussed that, because you're now providing equity rather than giving them a load of your cash. And also the risk for employees can be mitigated, because everybody knows, if you are having shares, that can basically, the share price can go up, but it can also go down. And many people say, well, that is great if you're a big investor and you have a lot of cash to play with. But if you're a regular employee, you want to reduce that risk of the share price going down. And you can do that, for instance, by working with an option. An option, like I said before, is basically the opportunity to buy a share at a certain price in the future. Well, simply, if the value of your equity, if the value of the share is lower than the price you have to pay, you simply don't make the trade. You say, I'm going to keep my cash. I'm not going to buy that share because I'm going to incur a loss. So therefore, the risk is reduced. Another way to reduce the risk is to work with a discount. Like I said before, you have a share that's worth 10 euros, you get to buy it for 5 euros. Okay, so if the share price drops, the first 50% of such drop is already covered by the discount you received in the beginning. So that's an interesting reason to work with equity plans. Dividend can be provided as an extra reward. And also the last one on the list here is the internal market. This is also an interesting one. Many, obviously nearly all startup companies are non-listed companies, which means there is no market for the shares. Basically, the shares, are you can only sell them back to the company. But if you create an internal market, you might be able to to trade the shares with your coworkers. So when, for instance, you own a large proportion of the shares, but you want to buy a new kitchen or a new car, you, through an internal market, could provide these shares to your coworker who already has a great kitchen, and therefore can say, okay, I'm buying these shares from you, and I'm giving you the cash instead. So that also makes the tradability of these shares a little bit higher. Well, if you have the whys, you can also have the why nots. Clearly, there are reasons not to do this, and we asked this again of the Fast 50 community. What are the main reasons why you would not want to implement such a plan? Well, first of all, the employees don't have the funds to buy the shares in the company. That's one reason that is mentioned. Another reason is that there is a high legal and administrative cost, and they are difficult to understand, and even we don't want to share any financial information with the employees. So these are some of the reasons that were mentioned with the in the Fast 50 community going on, and we are obviously, as advocates of employee equity, we're saying these are all the wrong reasons to stay away from these equity plans. First of them is being the excessively high legal and administrative costs. We think that if you use a standardized approach, whereby you work with a more or less standardized plan that is provided to startup companies, then you can reduce the costs significantly. We'll get to this in a later slide as well. If employees don't have the funds, there are multiple ways to work around this. You can obviously work with a company loan. You can also, again, say, well, if you are providing them with an option plan, the cash will immediately follow as soon as the trade is made. So for going back to that example that I mentioned before, you have the opportunity to buy shares for, let's say, 10 euros, but they are now worth 20. So as soon as you make that trade, as soon as you exercise your option, you are then provided with a benefit. So in principle, the fact that you have a cash flow problem in the beginning can be solved, for instance, by a company loan or another way, because as soon as you do that trade, if you exercise your option, you will be getting a benefit. Sharing financial information, we think that's actually a good thing. If you want to motivate your employees, if you want them to be really invested in your company, not just from a financial perspective, but also from a personal, emotional perspective, it makes perfect sense to share financial information with your employees, because that is how they know how the company is doing. Difficult to understand, like we said before, if you work with a standardized plan, which is straightforward and basically is implemented at a lot of startup companies at the same time, then you can create much more understanding with your employees. Oh, this is the plan, the more or less standardized plan that I see a lot of my my peers being involved with as well. It's not hard to understand, and it's it has a very solid and logical background to it. So it makes it easier to understand. Improving corporate performance. There's actually been a study done by a university in the Netherlands about 3 or 4 years ago that actually shows that equity plans do have a positive impact on corporate performance. There is a correlation which is shown over 15 years of data. We can share this investigation if you like. 15 years of data showing that indeed many equity plans have improved the performance of corporations. And you can only have equity plans in a public company. That's a misconception. You can also have an equity plan in a private company. The only difference is it's not traded at the stock exchange. But certainly you can have equity plans for non-listed companies as well. Okay, this was the first part of the presentation, which is basically the survey we did under the Fast 50 community. Maurice, you've been keeping an eye out for the question box. Are there any questions in the question box at this stage?
Yeah, one of the questions mostly asked, of course, is the timelines of when implementing a equity plan. How much time do you need for that? Is there also a timing calendar-wise? Should you do it at the beginning of a year, at the end of a year, stuff like that? Could you elaborate a bit on that?
Absolutely. Yeah, in principle, there is obviously some time required to implement an equity plan. Actually, like I said before, we are advocates of a standardized solution, which means you already have a lot of the plan documentation at hand. You have a standard valuation method at hand, and you have a standard administration at hand. If you follow the standardized approach, obviously timelines can be relatively short because it is, same old, which can basically mean that a little bit depending on the situation of your company, but the plan could be implemented in between 6 weeks and 2 months, something like that. So it doesn't have to take very long, provided you use a standardized approach. Let's see, what was the second part of the question again, Maurice?
If you look at it calendar-wise, then you have your end year, the beginning of the year, stuff like that. Because, of course, it sounds more obvious that if you end your year, you have your annual report that is being used to, for example, have a kind of evidence for the valuation.
Yeah.
So, therefore, logically thinking, you would say, okay, should maybe be at the beginning of the year after the last annual report is available.
Yeah.
Is that also true, or do you have another view on that?
It makes sense. Again, if you're working with a non-listed company, it basically means indeed that you don't have the ease of going to a web page and finding the value of the shares there, because simply there is no public market for your shares. So what often happens, like you already said, Maurice, is that the company needs to be valued, and typically you would value such company once a year. That means basically every year at one certain given moment in time, you say, okay, as compared to last year, the value of a company is now increased or decreased. And like you already said, Maurice, it makes sense to await the publication of the annual statement and the annual report, because that will give the most up-to-date information on the state of the company. So indeed, if you're saying, well, we have a tax year that runs from January through December, which is normally the case, then in, let's say, January, February, March, we publish the annual accounts. You will see that the typical moment to grant equity would be the month after that, because then you've done your valuation. Everybody has done also the rather tiresome work of getting all of the stuff, all of the information together, and then you have a very clean and clear valuation of the company, which is then a good basis to do your next equity grant. So in that scenario, with an annual grant, typically March and April are the months in which the grants are made. You will also see this, by the way, with listed companies, which usually follow the same cycle. So March, April are typical grant months.
And for non-stock listed companies, do you also see it on a 6-month basis, that people want to, for example, have a valuation because that is also a moment for them to cash on their options? Or do you say mostly is on a 12-month basis, so annually it's possible to then exercise your options or not?
Yeah, what we see is typically, especially for the non-listed companies, that it is done once a year, simply because, if you want to exercise your options, you want to have a very current valuation. You don't want to have a valuation that's, let's say, half a year or more than half a year ago, because a lot of things can happen in 6 months. So if you're looking for a biannual cycle, whereby you have one let's say in April and one in October, then it would make sense to also do another valuation again in October. And that's it's pricey, because a valuation in itself costs some money, and it's also quite a lot of work. So we would we see in practice that mostly these plans have a 1-year cycle, a yearly cycle, and that's also what we recommend, unless there are specific reasons why you would want to do it twice a year.
And one of the questions always is also I understand that you don't know all the specifics on a country basis concerning employee benefits and the taxation around it. Mm-hmm. But is there one country which is different than the others in a positive way for employees or employee stock option plans?
Well, there are indeed. I am a Dutch tax lawyer, so basically I studied tax law in a Dutch university for a number of years, and that was tough enough as it was. Obviously, I work in an international practice, so I see a lot of equity plans also for other countries. One thing I can tell you is that the rules, well, they are slowly converging over Europe. One country that springs to mind is especially Belgium. Belgium has a very specific set of rules whereby it makes a difference whether you accept a stock option award within 60 days from grant, and depending on that that specific action, the tax treatment changes. So Belgium is one of the countries that still has its own system, and it's quite different from many other European countries. But other than that, yeah, the typical tax treatment of a stock option plan is taxation at exercise. But yeah, to be sure of the tax treatment in each specific country, it still makes sense to have a tax advisor from that country look at your plan to make sure it doesn't fall into some certain tax law that makes the tax treatment different from the general rules. So again, the rules are slowly converging. There are some outliers in Europe, and it certainly makes sense to have a local tax advisor look at your plan if you want to know the exact details of the tax treatment.
And of course, there is now a lot of discussions around the Panama Papers. I don't think companies have decided to move their business to Panama because of stock options, but has in the past other structures have been used via tax havens, or was it out of the question for something simple like personnel options?
Obviously, I personally have not been reviewing the Panama Papers, so I don't know what will come out later on with all of these documents that are still, waiting for for the perusal of journalists and so forth. My personal experience is that the implementation of an equity plan itself is indeed in the realm of HR more than in the realm of corporate tax. And therefore, exotic structures like Panama or the British Virgin Islands or the Bahamas or whatever are not typically utilized for an HR-driven process like equity plans. Again, if tomorrow there's a big newspaper that says there was something like that in some country, then I don't exclude it, but it's not my personal experience.
No. But yeah, as you know, most entrepreneurs want to be tax friendly, or are tax friendly driven, to put it mildly. So of course, there's also one of the questions that they have about it. But that's also my personal opinion. Keep it simple, and if you go for difficult structures outside even the European Union, you make it yourself not that easy.
That's right.
Focus on business instead of tax.
Yeah, indeed. And I think also just as a professional tax advisor, I would never recommend to do anything that is is outside of the law, or even in the uncertain part of the law, whereby you are standing the chance of being later on incriminated for actions done in the past. It's best, in my opinion, to simply follow the law and arrange these things properly. Also because you're working with your employee capital, so it's one thing if you're more or less putting the company at risk. It might be bad enough as it is, but to put the individual employees at risk, or at least to put them in a situation whereby they could be affected by negative publicity, certainly doesn't seem like the right way to remunerate your employees.
No, I agree. No, those were some of the questions in the meantime. So please continue.
All right. So again, we talked a little bit about the excessive costs that are sometimes perceived and the excessive complexity of these plans. This next slide that we've shown is basically how we try to answer this problem. And the answer is, and I've said it a couple of times before, to work with a standardized approach. So if you were to provide an employee equity plan at low cost, which is quite easy to understand, we think that there are three things that you need to have right. And the first thing is the tax and legal approach. This is where Deloitte is involved. And tax and legal means basically, so the drafting of plan rules to make sure that these plan rules are aligned with the tax and legal requirements in any given country, and to provide some additional explanation in layman's terms to the participants in such a plan as to what the plan is, what it does, and how it will benefit them. So that's the first of the 3 steps. The second one is the valuation. We've mentioned that a couple of times before as well. Naturally, with a non-listed company, you want to know how your shares are doing, and the way to do that is through the valuation of your company. So that's something you have to have arranged properly. And the final one is the administration. Again, if you are in a company and you're giving it away to the workforce, it makes perfect sense to know who of your employees have how many shares. And the administration is the backbone of that. So just like your online banking system shows you, the amount in your bank account, the transactions that you've made, an administration of an equity plan is almost the same type of thing. You need to have it pat, not only for the current participants, but also in case your company is acquired by an investor, or even if somewhere down the line you want to go for an IPO. It makes sense to have a correct and up-to-date register of all of the employee shareholders, because that is something that is also required simply by your new investor or by the public at large if you're going IPO. So these 3 things we thought are very important, and I'm briefly going to go into each of these details in the next couple of slides. So the first step is indeed the tax and legal thing. And tax and legal basically means having the whole structure laid out properly on paper. I have a video on this. I could try to run it, but I'm afraid that it might not be.
Let's try.
Yeah, you want to give it a try? Okay.
Yeah.
There we go. Let's see. Can you hear it?
We can hear it, but we can't see it.
Oh. Okay, and I have a.
We will share the link. That's probably easier.
Let me quickly see if I can do this through screen share of the web page rather than the.
Yeah, probably that's easier.
Is this better?
Let me see. I see some pilers now. Double check with somebody next to me, but also a laptop. No. No. Oh wait, yeah, no. Something is coming into the screen here at my end, but there is. How do you say?
It's a lag, probably.
Yeah, there it is. Yeah, there's a lag, so I should shut up now. Otherwise, it's shifting all the time to my screen. So it's working.
Okay, so let's start it again. Here's the video. All right.
I think the sound was a bit bad, but let me briefly explain to the viewers that what you've seen is both those monkeys had to give a rock to the scientist, and therefore they got a incentive, being a grape or a cucumber. And the grape was being rated higher than the cucumber. So the left monkey got the cucumbers, and the right monkey got the grapes. And therefore you saw the left monkey becoming aggressive because he didn't get the grapes, but only the cucumber. So that was the experiment, if I'm correct.
That is correct indeed, Maurice. So again, the link is covered also in the sheets. If you want to look at it, you know, and enjoy it to the max, then certainly feel free to look at it later. Okay, so basically, yeah, that experiment shows how not to do it. So if you want to provide, you know, if you want to create inequity between people, yeah, then the wrong way to do it is to say, well, one of my employees will get the cucumber, the other one will get the grape, and we're not explaining the reasons behind it, and you get a lot of angry participants in your company. So instead, the design of a reward strategy should be, you know, based on your business strategy. And the scheme that is on this slide basically shows what what the steps are that need to be taken in such an approach. So first of all, define your business strategy. What is the overarching the strategy for the future that your company is looking for? For instance, are we going to go for an IPO? Will we be will we acquired? What type of organization do we want to be? Then, when you've defined your business strategy, you define your remuneration philosophy. And this basically means that, yeah, the remuneration of your people should follow the business strategy. If you want your company to go into a certain direction, then it makes sense to align your KPIs, your performance indicators, in such a way that indeed the goals of the company are supported. Then if you've decided on your remuneration philosophy, the next step is to look at your strategy. Basically meaning, okay, what part of our life cycle are we in at this stage? Are we just starting out, or are we already scaling up to be a more established startup company? Are we even already gearing up for an IPO or an acquisition? This is the flexible part of your remuneration strategy, because obviously depending on the phase in your life cycle that you're in, a different remuneration might be required. And only after going through these three steps, you look at the basic remuneration policy, which consists of salary, benefits, pension, bonus, and equity. So again, we always, we try to follow this particular strategy, this particular step plan, to make sure, your equity plan follows your overarching business strategy. And this is why we basically decided within the standardized approach, we should not have a one-size-fits-all methodology. We should have a choice of, in this case, 5 different plan types, so that there is something to choose, while at the same time we keep it straight, we keep it logical, and we keep it understandable. So the 5 more or less tastes of plans, or varieties of plans, that we have determined are listed on this slide. The first 2 are, in fact, not based on an equity payout, but on a cash payout, with the top one being the bonus plan. Well, a bonus plan has as an advantage, it's relatively straightforward. You simply provide a person with a certain cash amount, which depends on his performance indicator. The next one is very similar and looks quite like a bonus plan. It's called a share appreciation right, or a SAR. Probably a term you might have heard used in various circles. A SAR plan also provides for a bonus, but it's a special kind of bonus. It means that, for instance, if in the beginning of the plan your share price was 10 euros, and at the end of the plan it is 20 euros, you get a cash bonus of 10. So you don't get equity, you get a cash out, but the amount of the cash is determined by the increase in value of your shares. So these are the cash remuneration types, and then we have 3 more varieties. Which the first one is the well-known one, the employee share option. It's the entitlement to buy shares during a preset period at the preset price, the strike price. So again, right now the share price is 10 euros. You get the opportunity to buy these shares somewhere down the line for 10 euros. And obviously, this is going to make you work really hard to get the share price over the 10 euro amount. So then you can buy something worth maybe 20 euros for a simple price of only 10 euros.
Don, one question. I see there's still the Capuchin movie slide on the screen.
Oh, that's not good.
So I think
I'm going to start.
Resume slideshow, that then everybody has the same overview again.
Good idea. Okay, hang loose. So I'm going to call up the presentation again.
Yep. And then share screen, and then we should be fine.
The screen share, let's see.
On the left-hand side.
There we go. And then see if we can find the PowerPoint again. There we go. Start the screen share. Can you see it now?
Yes, it's back. Sure? And let's see. Yeah, now scrolling down to the.
Yeah, now scrolling down real fast. This is going to make you very dizzy.
Yeah, no worries. No, but it's there again.
Okay, very good. So this is the slide I was talking about.
Perfect. Thanks.
So again, yeah, we've covered the bonus plan and the share appreciation plan. We're now at the employee share option, which, like I said, has no potential disadvantage, because if in principle the price is lower than the 10 euro amount in the example I just gave, you simply don't make the trade. If it's above, you make the trade and you immediately get your cash. Then the next variety that we have is the share purchase plan. This is the entitlement to buy shares, normally out of your net wages, and you either get it through your private means, through a bonus, or through a saving amount, whatever. It can be provided at a discount. You can say we have the buy one, get one for free possibility. And like I explained in the beginning, there is the potential capital gain, because if you simply buy shares that are worth, that have a low value at this moment, and then, you know, after you've bought them and they've become part of your capital and the value goes up, then that will provide you with a capital gain. And then the final variety that we have is deferred shares, which basically means you receive your shares under a suspensive condition, which means that you only get the ownership of them when the KPIs are met after a certain period of time. So you don't become a share owner just at the beginning of the plan. You only become a share owner at the end of the plan when your KPIs have been met. So these are the 5 varieties that we have included in our standard approach, which means we look at your company strategy. We say, okay, of these five varieties, which one would fit your strategy best? And there is indeed something to choose. You want to choose between remuneration in cash, if you prefer that, remuneration in equity. There is the opportunity to build in these safeguards, which means, for instance, in the employee share option plan, that you say, okay, I don't make the trade if the exercise price is lower, if the value is lower than the exercise price. You can get these discounts and loans for the share purchase plans. So there is a lot to choose, but you still look at the more or less standardized approach. Then, once we've identified in your specific situation which plan is best for your strategic goals, then we design the plan for you, which basically means we have a meeting with you and whoever is involved in driving this process. We select the plan choices, we verify the tax and legal aspects, and we identify who is going to be a participant in your plan. So who are you going to, to write the plan for? This goes back to a previous slide on whether you want to include the entire population or just, the management or some typical, groups of employees, just like the share or the salespeople and so forth. Then the second step is we implement the plan for you. We draft the documentation, we provide the plan rules and so forth. And then the last step is to communicate on the plan, because again, we feel that you might have a great employee equity plan in place or a great bonus plan in place, but if your employees don't understand exactly what they are signing up for, then the plan will have very few participants, and basically it's been a waste of time and effort. So we ensure that there's a communication to the participants. We ensure there's communication to the other stakeholders in the company, and we wrap it all up with a conference call with you to make sure that there's no loose ends remaining. Then the next part probably is something that you might want to explain on a little bit, Maurice, because it is part of your particular expertise, and it's on valuation.
Yes, thanks for that. And maybe also heading to the next slide. But when I talk, the slide isn't being shared on screen. But I can briefly explain a bit about it. Of course, valuation is always looking at the future value of a company, and there are different ways how to value a company. For the people who didn't know, my background is also a chartered financial analyst, meaning that I'm capable of making valuation in cases of, for example, mergers, acquisitions, and stuff like that. But if you look at how to value, there are 2 to 3 ways to look at it. First of all, you could look at the balance sheet by saying, okay, what are the assets on the balance, and what is the current value of it? Secondly, you could say, okay, what is the multiplier that we can use? And you can say, okay, it's 1 time the turnover, it's 7 times the net profit, 3 times EBITDA, stuff like that. But most importantly, especially with non-stock listed companies, it's better to look at it from a free cash flow perspective. By saying, okay, we're going to make a forecast on of the company for the coming years. And we're going to have a look at the free cash flows that will then come out of this company. And we value that to the current value of the company itself. It is important to keep in mind that you have accountants who are great at looking backwards, but you need the people who are capable of looking forward. And therefore, our advice always is take on a chartered financial analyst, somebody who can also be a soundboard to your management team on how to create a good forecast, and also how to create management tools concerning value. Because a chartered financial analyst is capable of also explaining where your value drivers are. So is it on getting some extra cost savings in your company, or is it looking at your margins and maybe do a peer group analysis by saying, okay, if you get better margins, looking at your peer group, probably your value will go up. Stuff like that is really important, especially if you want to incentivize your personnel on a value-based approach, of course. So that's a bit about evaluation. Take somebody within your network who's well known, or who has the expertise to do it, and most of the times that is not your current accountant. So keep that in mind. And one other thing, Don, is also to keep a bit track on time, because we have a few minutes left. Mm-hmm. What I think it's important to, of course, people can also have a look at Money Day, but that is maybe easier for just doing it by themselves. I think it's good to touch a bit on the costs of things concerning tax-wise, administration-wise, and also valuation-wise. Because there's also that sheet with that overview. Maybe we can use that sheet as a last sheet, and then close the session.
Yeah, it's actually not on the presentation that we have right now.
Okay.
But I can look it up quickly. It's not a problem.
You have a ballpark figure, as far as I know, and I think that's always the question for people is, okay, what will it cost our organization if we want to implement this? Yeah. And there are 3 cost structures, so to speak. One of is the tax, secondly, the valuation, and thirdly, the administration. And if you look at the tax plan itself, and then of course there are costs of the taxman, so to speak, or your Deloitte in this case.
Exactly.
But that is not annually. You design a plan, and after that, only when you redesign a plan, there are costs involved. And secondly, there's the administration, and you could use Excel, but there are other tools available, like the Money Day tool, which then administrates it automatically. And it is, of course, an advantage, because your personnel can then have an insight on their own option plan and the value of it, and they can do it directly online. And they don't need to ask your HR officer, for example. And then thirdly, there is the valuation, and that is, of course, annual cost. And first of all, you have your basic valuation, and secondly, you have your annual valuation. And our experience is from the past also is that a basic value, or a start valuation, so to speak, will cost between the 5,000 and 15,000 euros, depending on the complexity of the company itself. And the annual valuation after that will cost between the 3,000 and maybe 8 to 10,000 euros. But those are ballpark figures, of course, because it all depends on the complexity of the company itself. Okay, I see you have found the slide. So maybe if I then again shut up, the slide comes in the screen itself, and people can see it there. And you can tell a bit about the cost of Deloitte, for example, in this case.
Yeah, exactly. Well, again, and I understand that while I am talking, the slide remains on screen with the participants, so that's good news. So they can briefly have a look at it too. We will make sure that it is also included in the version that we distribute after this call. Yeah, and basically all of the things that you've just mentioned, Maurice, are in there as well. Again, you see the Deloitte fees for 3,750 for the plan and the meeting and the call. The administration solution is a setup fee of 3,750, and then the annual recurring fee, because basically you have to keep that system updated and it has to be online throughout the runtime of your plan. And of course, like you said, indeed, the valuation. And the valuation, it takes out a large chunk of the of the budget, but it is also the most important one. It's simply because you are not a listed company, you need to be valued. It basically makes sense to do this through a registered valuator, which then ensures that your discussions with the tax authority on the valuation of your company will run much more smoothly, because you can refer back to indeed a registered valuator that has done his homework and made sure that all of this was done in the right way according to the best practices within the valuation trade. And therefore, the valuators, they make a distinction between companies with a turnover of less than 1 million, turnover between 1 and 10 million, and a turnover of more than 10 million. And the setup fees, as you can see at the bottom right-hand side of the slide, run up from 6,500 for the setup, which is a one-off, to 3,500 recurring. And then if you're lucky enough to have a company with a turnover of more than 10 million, that amount becomes a bit higher, up to 16,000 setup and 7,000 annual.
Okay, perfect. Thank you very much, Don, for sharing all the information with us. Also, we must maybe share now a bit in the end the hassle that it took, or the time that it took before you were connected, because Deloitte, being a really safe company, they've blocked all sorts of plugins to your computer.
Yes.
So it took a couple of hours, and your help desk or your IT colleagues had to also interfere with this. But more than happy that you made it, and that we could have this Ask Me Anything session. What we will do is, of course, we will share the slides and therefore also your contact details. If people have any questions, they can connect to you. But of course, probably you will forward their questions to the country from origin, of course, because you are only involved in the DAX or in the Dutch tax business. Thanks again. We will share the slides. I don't know if you have anything that you would like to share to the group as one last remark, one final thing.
Final remark? Yes. No, indeed, I would. First of all, it's been a bit of a challenge indeed to get this whole thing operated, but now that it's running, I think it's a lovely way to keep in touch with all of the people within this community. It's a community that we value a lot within Deloitte. We are really happy to be part of this this European-wide initiative to increase shareholder ownership within startup companies. I feel, and I hope I've been able to put that message across, that it makes perfect sense if you're a startup company to ensure that you have an equity plan in place. I think the benefits are much larger than the potential drawbacks, and indeed with the standardized approach that we have been able to develop together with the registered valuators in the Netherlands and MonID and Deloitte, we have a great opportunity to make sure that people wherever in Europe can provide equity plans to their to the employees within their startup company at a cost efficient way. And any time that I can spend to put this message across is worth definitely the interaction with our service desk and the opportunity to get plugins playing in a very sophisticated manner. It's all worth it, because it's, I think, something I really believe in, and it's going to benefit the startups in Europe everywhere.
Okay. Yeah. thanks again, and thanks all for participating, of course. This will be also available online, so if some of the subjects were touched too fast or anything, you can always look at the video again and listen very carefully to the message that Don has shared. Thank you all, and I wish you a pleasant evening.
Same here.
Cheers. Bye-bye.
Bye.